All I can say is that how many letters have you gotten from a lot of analysts on Wall Street saying deadline in quotes? I mean, how many people are treating these deadlines like actual deadlines? Are we really worried about the penguins? I mean, at a certain point, which are the true trade partners that are going to matter with the United States that are going to have non-negotiable letter type levels?
Everything's negotiable to an extent.
Exactly.
Obviously. But it feels like once you've secured a deal with Japan, with the EU, once you've basically concluded you're going to kick the can with China for 90 days, this is kind of it for everybody else. At least that's the sense I've got of things.
I would agree, unless there's some sort of strategic significance with respect to transshipments from China, unless there's some kind of real reliance on a specific nation, it will be over, which is the reason why this market's moving on.
With two exceptions, Mexico, Canada, which could take another 18 months.
It's going to be fun. I think that's what this market's
It's a lot of fun in store. Here's the view on Wall Street. Abby Yoder of JP Morgan Global Wealth Management writing, investors have turned risk on. Fears over trade and policy setbacks are fading as investors focus on strong fundamentals. Abby joins us now for more. Abby, good morning.
Good morning.
Question we've been asking all morning. We know what the tariffs are for certain nations. Do we fully understand the consequences?
Well, I mean, I think on a relative basis, yes. Like if we're thinking about where we were in April versus where we are today, and you're thinking about, from a corporate standpoint, when we were going through 1Q earnings and you had all of these different scenarios and these worst case scenarios in terms of what kind of hit they were going to take from tariffs, like that left tail risk has certainly moved, more to the right. So I think that's in particular very good for the stock market, generally speaking.
You've said strong fundamentals. Are you confident the worst of the data is behind us and not in front of us?
No, and I think the market knows that. I think the market knows that we're going to see this. You see it in consensus estimates, right? You're like on your Bloomberg terminal in terms of what happens in terms of economic growth as we head through the rest of the year. That's relatively well understood. What the market is thinking and looking at is, okay, this is a blip, right? We have this second half weakness, but then we go into 2026 where we have the reconciliation bill, which is really like a cash boost in terms of thinking about corporates. And we've got like pretty solid earnings so far, right? From a profit margin perspective, we're really hanging in there. We're still above the long-term average in terms of profit margin. So in terms of company performance, yes, you might see a slowdown in economic growth, but you're still seeing really like resilient results from companies.
So why isn't your current base case higher for the S&P 500? It's currently at a range of 5,900 to 6,300. We're surpassing that. We're almost at 6,400.
Yeah, and so, we do have a bull case, and that is 7,000 to 7,100, and it feels like we're inching closer to that, right? Like when you put all of these pieces together, again, you take out that left tail risk as it relates to Liberation Day levels. You have this really strong, we're in the middle of 2Q earnings. Coming into the season, expectations were for 4 to 5% growth. We're already close to 7% growth with what's reported. We obviously have a 30% of market cap reporting this week, but it's been really solid. So, as we get these trade deals and we think about the scenario analysis, it does feel like we're leaning closer to that bull case.
It seems like that's what we're hearing from Mike Wilson over at Morgan Stanley. John Stoltzfus over at Oppenheimer came out and raised his expectation for the S&P year-end target. I just wonder what we could hear this week that would give you that confidence. Is it some sort of projection into 2026, given that that's when the strength is expected to resume?
I don't know if it's necessarily a project. Like we're not anticipating, because you don't typically have companies do that in the middle of the year. But it does seem like there's more of a focus on 2026 right now than there is historically when you're in July and August. But I think, if you have mega cap companies that are committing more capital to their AI spend, and this is across sector, right? Like we're thinking about it not just within tech. I think that in and of itself lends it to like more clarity on what 2026 could look like, right? Because if more companies are spending on this productive capacity in terms of technology, that bodes well in terms of 2026.
Do we need the Fed to cut?
I'm surprised that you're starting to see more of this cyclical rebound in terms of price performance without that. Like that felt like it was necessary in terms of getting that, because manufacturing's been basically in a recession for 3 years. What gets that rest of the market, that part of the market working? And I mean, think about it. You have these commitments to spend in terms of, across the board in terms of sectors. Like let's use pharmaceuticals, for example, $300 billion in commitments to reshore, to rebuild manufacturing, which in and of itself could create more of a tailwind for industrial capacity despite higher rates.
You've talked about how forgiving the investors are going to be of potentially weak data in front of us. And I just wonder how relevant it will be if the Fed isn't cutting interest rates. We just heard from a guest 15 minutes ago, said no cuts for 25. We've heard that from other banks as well, from Morgan Stanley, from Bank of America. Is that relevant to your bullish view on the equity market?
Yeah, so we do, in our base case, have 2 cuts this year, and another 2 through the first half of next year. So we do have an easing bias, which in and of itself is very important when we're thinking about valuations for the S&P 500, right? You have the combination of strength and earnings growth with an easing bias, right? Like, I don't think anyone's debating right now whether or not the Fed's going to hike. Like, I don't think that's really on the radar. It's just a matter of when they cut that can really, I think, sustain valuations from here.
What's more important for you this week, just to sum it all together? The Fed meeting, the earnings, or the economic data?
I think I'm an equity strategist, so earnings are going to be very important. Obviously, that's going to be more idiosyncratic depending on what industry then. And then I think, I really do think the employment data, obviously, that's the main focus right now. And it was interesting when you were talking before, you were saying like, oh, but the labor market's solid, but it's weakening at those 2 things are happening, right? Like that the labor market remains solid, but you are seeing some weakening at the margin. So thinking about what happens with labor market data this week, but, unemployment claims have been pretty tame over the past couple of weeks.
What's your pick this week?
I would pick earnings, actually.
Would you?
Yeah, because I think that employment... So
we're on the same team.
We're on the same team, yeah. I think
because you're sick of the Fed chat or because it's more important?
Well, yes.
Yeah, you guys didn't sound excited about the Fed.
Well, I just feel like the market isn't that excited about it, and we already know it's going to happen. I just feel like the earnings really is a different story. It's the AI sort of secular change that is underpinning the strength that so many people have gotten behind. And that's pretty exciting to me right now.
Apple front and center for me.
Yeah, exactly.
That company's in a tough spot right now. Leadership is arguably as well, in a way they haven't been for a long time. They've
been on the back foot when it comes to AI. They've got this situation with China, and Tim Cook no longer diplomat-in-chief. So then all of a sudden you have a real problem when it comes to relationships with the president.
Jensen Huang, the man in charge, apparently.
Yeah, exactly.
Foreign policy as well on certain issues too.
Evidently, what's the difference?
Just to finish, Abby, on the international backdrop, this preference for international over the US over the past several months, in the midst of all this trade volatility, what is the argument now for superior returns in a place like Europe? Well,
so I think if we focus again, if we're thinking about 2026 rather than 2025, the bull case is that for Europe versus the US is that you're starting to see a convergence in that growth rate, right? Like there's been a really wide, divergence in terms of earnings growth in the US versus Europe. But now you have this domestic story as it relates to fiscal spend, mostly stemming from Germany, that could really propel, we're not calling for that gap to close, but if you see it, shrink, that in and of itself could uphold valuations and create more of a tendency for investors to.
They're going to borrow in the debt market to fund US defense players now, based on the agreement over the weekend.
Let's see. And frankly, everyone wants to go to their debt market because it's going to be the new reserve currency, right?
Apparently.
Yeah, that's what we hear.
Sure. Abby, thank you. Appreciate it. Thank you very much. Abby Yoder there, JP Morgan Global Wealth Management. I don't think we've seen the end of the fallout from the weekend from the Europeans. There's going to be pushback. The Spanish government joined us in Washington, D.C. a few months ago and referred to the Chinese as allies. Do you think they're going to be willing to get on board to accept a 15% tariff and then go after Chinese overcapacity? I certainly didn't get that sense, did you?
No, and we've already heard some dissent coming from France in particular and a couple different ministers there. I do wonder how much this does threaten some of the unity of the European Union and really raise some of the issues that have blocked that region from having the sort of economic power that they should based on some of their productive capacity.
Euro dollar this morning negative by 0.75%, 116.55. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump speaking in Turnberry, Scotland minutes ago alongside UK Prime Minister Keir Starmer. Trump telling reporters, quote, "We're in a great shape with the UK and we want to make Starmer happy," potentially talking about trade there. The president also said he discussed Gaza with Starmer at their bilateral meeting and said he won't take a position on a Palestinian state. Meanwhile, U.S. and Chinese officials are meeting in Sweden today to extend their trade truce beyond its August 12th deadline. It will be the third meeting in less than 3 months between Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng. A breakthrough during these talks could set the stage for a meeting between Trump and Xi Jinping later this year. And the heat is on here. More than 132 million people across the central and eastern U.S. are facing blistering temperatures this week, with rising humidity making it feel even worse. And putting a strain on the energy grid. This has been the third hottest July on record. That's your Bloomberg Brief. John?
Yahara, appreciate it. More from Yahara in about 30 minutes. Up next, the morning calls, plus Scott Devitt of Wedbush with Mag 7 earnings on deck. That conversation up next.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
We've reached a deal. I think you were saying this is probably the biggest deal ever reached in any capacity.
We have a deal, and it's a big deal. It's a huge deal. It's 15% tariffs across the board, all inclusive.
I think it's the biggest deal ever made. Thank you very much. Congratulations.
We have a deal between the EU and the United States of America over the weekend. That was President Donald Trump and the European Commission President Ursula von der Leyen. This market feeling pretty good about that deal worldwide. Equity futures still positive this morning on the S&P. Mike Wilson of Morgan Stanley leaning more towards our 12-month bull case, 7,200. Drivers are positive, he says. There's many of them. I'll give you a select few. AI adoption, dollar weakness, easy growth comparisons, pent-up demand, and Federal Reserve interest rate cuts.
And he's not alone. We heard that also from John Stoltzfus, upgrading his forecast for the year, expecting another 20% plus return for the S&P 500. And just now, Abby Yoder from JP Morgan Asset Management looking closer to their bull case, which has a 7 in front of it. And this really is, right now, the story on Wall Street.
Crazy how much this story has changed over the past few months. So the bear case became the base case back in April, and now the bull case has become the base case a few months later.
I think we cannot underestimate or can't overestimate how much the deep-seat questions that got overturned with ongoing tech investment superseded some of the concern about global tariff slowdowns that we haven't seen materialize yet in the economic data.
Futures positive by 0.2% on the S&P. That's the price action. Here's some morning calls. First up, Wolf Research upgrading Texas Instruments to outperform, seeing it as well positioned to benefit from a cyclical recovery. Your second call from Oppenheimer raising its price target on Shopify to 145, citing lower tariff risks. And finally, UBS raising its price target on Amazon to 271, citing extensive investments in e-commerce and cloud services. That stock is up by 0.75%. Let's stick with the Mag 7. Another busy week of earnings coming up with Meta and Microsoft reporting on Wednesday, Apple and Amazon on Thursday. Bloomberg's Ed Ludlow joins us from the West Coast for more. Ed, good morning, sir. 4 big names coming up.
Yeah, good morning. And I think we know it's just all about tariffs. I was listening to your last conversation and, Apple is in a difficult moment right now, John, and how you framed it in the context of management, really interesting. We know what we're looking for. You know, in the last earnings call, they said that in this current period, tariffs would account for about $900 million of additional costs. But for a company that's forecast to book $62 billion of revenue just on hardware, I'm stripping out services there, that doesn't seem like much. But given the change in the leadership and the shuffling that Tim Cook's done, does Tim Cook, the operator, kind of do what Apple's always done, which is manage the bottom line, find solutions? So the $900 million figure on a tariff cost gives us something to benchmark against, to look at, plus or minus, and see what they'll achieve. But what they're doing in China is really interesting as well, because while globally they are encountering these pecuniary penalties and issues, in China they've done heavy promotion, heavy discounting to get themselves back to growth in that greater China marketplace. So there's a lot to discuss.
Ed, looking forward to the show. At 11 a.m, Bloomberg Technology. Look out for that alongside Caroline Hyde. That's the latest on big tech and Apple specifically. Let's talk about Meta. This from Scott Defford of Wedbush, reiterating his outperform rating on the company with a $750 price target and writing the following. Investor sentiment has remained encouraging for Meta ahead of Q2 results. The risk reward is attractive, given healthy fundamentals and optionality related to future AI monetization. Scott joins us now for more. Scott, welcome to the program. What a quarter it's been for Meta. And I'm not talking about revenue, I'm talking about hiring. Just some big names and some big money. Do you think investors will continue to reward them for that?
Well, we're going to find out soon. You know, I think top line has held up remarkably well. You know, this company is only a few years removed from the removal of IDFA on Apple devices and a very difficult period for the business, and is now kind of clicking on all cylinders. And now we're entering a period with Meta where the company is very front-footed on spending again versus that year of discipline it experienced in 2022. And so it'll be interesting to see if margins stop expanding because we're now spending into the future of AI, whether the stock performance continues to be as strong as it's been. We're optimistic, but probably a little less optimistic on Meta here than we've been more recently because of that.
Scott, it's fascinating to hear you talk, because I remember when spending was considered a really good thing, the more they spent, the better. And then all of a sudden it was a bad thing. People were wondering if maybe some of these hyperscalers and other tech companies were overspending on AI. It seems like we're shifting back to where we used to be, where more spending means more promise, akin to what we heard from Google. Why is that not the case?
Well, as you all just so eloquently described, things change month to month and quarter to quarter. We're 3.5 months removed from Liberation Day, when all the strategists' forecasts were significantly lower than they are now. And I think that the narratives around stocks are very similar. So if Meta hits a period where it isn't exceeding investor expectations for growth, then the spend concerns become more relevant again. I mean, this company, you know, is a company that did spend aggressively on metaverse. A lot of that spend is now being, you know, infused into their AI initiatives. But stories change, you know. So I think right now spend is good. For the companies that I spend most of my time on, which are consumer-facing companies that are spending all the dollars to the semiconductor companies, you know, they're going to have to figure out how to use AI effectively to drive sustainable growth, or what's viewed positively right now, which is the spend, will flip again, you know, sometime in the next 3, 6, 9 months.
Well, you went there.
And that's what I have my eye out on, you know, because nobody's really focused on that for Meta, and it concerns me a little bit.
So Meta being a consumer-facing company, Apple is the primary consumer-facing company. How much do we expect to learn about them in terms of what kind of punishment they're getting on the consumer side, given that they haven't been on the front foot when it comes to AI?
So with Apple, you know, there was a period where the lack of a need to invest in AI was viewed as a good thing, because whatever worked could be layered into, you know, Apple services, and the capital efficient business model would move ahead. And so as long as consumers are still buying Apple devices, it didn't really matter. You know, now there's a view that Apple needs to play aggressively in this area because its historical reliance on Google, you know, for traction that's now under scrutiny by the government. And so with Apple, you know, I think they're going through a bit of a narrative shift, which is difficult to deal with when the multiple on the stock has gone up 3x over the past decade. So, you're paying 30 times earnings for GDP plus growth. And that's the primary problem here, I think, is the multiple more than that the company is going to be proven to be deficient as we go into AI, because you can already use ChatGPT integrated into Apple, and just like you could use prior generation of search, you can now use AI.
They're in a tough spot,
devices.
Scott, without a doubt. Scott Devitt there of Wedbush. That name is down by almost 15% year to date.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Live from New York City this morning. Good morning to you all. Futures positive by 0.2% on the S&P with 60 minutes until the opening bell. With your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. We're looking at the energy companies continue to rally this morning, specifically the LNG producers. You can see Cheniere, EQT, Venture Global, all of them rallying at least 1.8% after agreement between the U.S. and EU over those tariffs. A part of it, $750 billion from Europe will be poured in to U.S. energy. Meanwhile, Tesla also on the move pre-market, an announcement that Samsung would be building chips for them in Texas. I just wanted to point out that Applied Materials is also rallying as part of this story, up 1.8%. Applied Material, their second biggest customer is Samsung. So we're seeing some of the Samsung suppliers rallying on that too. Finally, this morning, we are seeing a rally coming from Norfolk Southern, up 1.8%. Over the weekend, Bloomberg reporting that likely this week we will hear the finalization of a deal between them and Union Pacific to merge. Union Pacific would be buying Norfolk Southern. I have to say there's been some reporting on the story, at least for the past 2 weeks, so the stock is up 10% so far this month, which maybe is why you aren't seeing a bigger pop. But still, that deal may be to come this week, John.
Danny, appreciate the update. Thank you very much. The opening bell just an hour away and futures are doing okay. Busy week of economic data ahead of us as well, including a Fed decision on Wednesday and payrolls on Friday. Mike McKee has a preview. Morning, Mike.
Good morning, John. Well, we're going to be somewhere in between all sound and fury signifying nothing and the complete template for the rest of the year for Wall Street, because we do have a lot of data. The question is, what will it tell us and how much will it matter in the end? There is one event to rule them all, and that is, of course, as you mentioned, the Fed meeting on Wednesday. The questions there are, what do they signal about September? Because they're going to leave rates unchanged. We pretty much know that. Do we get the dissents from Waller and from Bowman? And does that matter to people? What does Jay say? Now, that's going to be important. Does the Fed chair have any comment on the president? And certainly then the question is, what is the president's comment on what the Fed does? On the economy, meanwhile, we have a lot of numbers starting tomorrow with the Conference Board confidence numbers. We also get jolts, but that's a little less important these days. How are consumers feeling? We're going to have a sort of a gut check on whether we think people are going to keep spending. Wednesday, we get ADP, totally overshadowed by GDP, but GDP, we're going to have to figure out what it means because of the trade distortions that we saw in the first quarter. How much of a rebound is real? How much of it is just a rebound and a statistical distortion? Thursday is income and spending and PCE. Of course, we'll want to see what happens with spending, but PCE is going to be the question. And right now, analysts are expecting a slight rise in inflation, and we'll look under the hood to see what tariff impacts there are. And then, of course, Friday's the big day. The labor market, jobs day. Do we see a slowdown in hiring? That's the forecast. Do we see unemployment go up? That's not forecast at the moment. And the question then becomes, how much does this matter? Because we get a couple more payroll reports and CPI and PCE reports before the Fed will next meet in September.
Before we get to September, Mike, might have some dissent on Wednesday. Can we just talk about that dissent? How much dissent do you actually think we'll get?
I suspect that Chris Waller is going to have to dissent. He's put himself in a position to do that. He could make the argument that if we get GDP or PCE numbers that suggest that things aren't all that bad, that he's okay with holding, but he wants to cut in September. Mickey Bowman's a more interesting question because she had said if the economy develops in certain ways, we could see a cut in July. She didn't promise or advocate it as much as the Governor Waller did. So we'll see, and then it's going to be a question of whether the market thinks it's important or not, or it's been telegraphed so much that it just gets lost in the noise about September.
Mike McKee, thank you, sir. Looking forward to the Fed decision on Wednesday, payrolls on Friday. Steve Rasciuta of Mizuho with a bullish forecast for Friday's payrolls report, calling for 140,000 jobs to be added and expecting the unemployment rate to tick up slightly. Steve joins us now for more. Steve, good morning.
Good morning.
Sign of the times that maybe 140 is called bullish now for the labour market. What's changed?
Well, you are further into a business cycle. You do have a labor market shortage. You do have a very, very tight labor market. So it's hard to continue to add large scales without causing a certain amount of disruptions and a dramatic rise in wages. And I think companies have been resistant on that. I also think there's a bit of a technology shift taking place. I don't think it's all the AI, but I think it's further adopting of the traditional types of technology that we need to do things in the service industry with more and more kiosks popping up everywhere. And I think that helps the situation as well. So we're supplementing labor or a little bit with capital where we can.
You have some people like Chris Waller, governor, who's expected to dissent, the first dissent on the Federal Reserve since 1993, potentially on Wednesday, coming out and saying he's seeing cracks, he's seeing signs that there is instability in the labor market. Do you reject that wholesale, or do you just say that that is something that comes along with the changes in technology and demographics?
Well, I do reject it wholesale, because what we see in terms of the claims numbers, what we see in terms of the continuing claims numbers, leave us in an environment in which, there's a healthy labor market environment. We see no evidence whatsoever in the data that's less likely to be disrupted by any kind of flow differentials. We also see it in terms of the JOLTS numbers, which I don't particularly like, but the Fed seems to like, in terms of hiring, quits going back up, in terms of hirings being healthy, in terms of job openings going back up. So I don't see where there really are cracks in the labor market. It's a traditional a slowing that takes place as you get this far into an environment, and, oh, by the way, adjust it for how tight the labor market fundamentally is.
Given the fact that we do see some sort of slowing, at the very least, is there anything inflationary about this labor market? Is there anything about wage growth that would give you confidence that we could see more than just a one-time price adjustment from tariffs?
Oh, I think you're going towards a 3% inflation rate, and that's part of the issue. I think it's from a labor market tight standpoint. I don't necessarily have to talk about tariffs to tell you I think we're going to 3% inflation. And I question whether or not tariffs themselves will be reflected in prices substantially, because you look at, importer margins, they're very, very wide. You look at exporter margins with the dollar going down, you've got that benefit coming through. The little bit of goods prices we've seen, given the fact that the dollar has depreciated 6 or 7% in the last year, not surprising you see a little upward movement in prices that would typically just take place from the currency standpoint. And actually, it's not even keeping pace with the currency standpoint, because global deflation is real. And that's the other thing that's offsetting and helping the exporter margins widen, because as China dumps all its goods everywhere else in the world, these people are sitting there with their raw material base starting to get cheaper, and therefore they could absorb the margins more. And China is dumping goods everywhere that they can't dump here anymore.
Overcapacity is a massive issue, particularly for the Europeans, that's for sure. You said something really interesting that we need to unpack. The labour market might be a reason to be hawkish still. Governor Waller was in your seat a week, 2 weeks ago, and made the case that the labour market is increasingly becoming a reason to be dovish. So I just want to give you some time. What's happening in the labour market right now that you think is going to keep them on the back foot?
I think the fact that the unemployment rate is not going to go higher. I think the movement to 4.2, we've been there and they've done nothing. But I think when you look at the fundamentals of the labor market and what will drive that unemployment rate up a little bit, you're going to discover that it's positive signs, an expansion in the labor force from not having expanded for 2 months in a row. That's going to be the kind of thing that gives you an environment where, and that's probably going to wind up in a little bit increase in unemployment temporarily. You're going to wind up in an environment where it's a healthy expansion in the labor market, healthy upward adjustment in the unemployment rate. I don't think there's cracks in the system. When I look at the earnings numbers, my earnings revision tracker is now positive after being negative for weeks on end. It's now been positive for 3 weeks in a row. Companies are revising up earnings. We're at 10.9% for this year, 13.9% for next year. These are solid earnings numbers. These aren't kind of an earning number where people sit back and say, I have to scale back on employment dramatically. And I think a lot of the announcements that you're picking up on in the labor market are taking place in states where you're required to announce the layoffs, but you're not required to announce the net hirings. And I think that becomes part of the problem. It's selective decision to look at the information. And this is a confirmation bias I think comes from the dots. If I were to drop Jonathan Ferro out of an alien spacecraft, you had been studying the Federal Reserve for years, you'd been studying the U.S. economy for years, but you didn't know anything about the dots, and I dropped you in Arizona right now, okay? You would come out of that spacecraft and you would be like, oh, the Fed shouldn't be cutting rates. But everyone else says the Fed's cutting rates. Why? Because the dots are there. So everyone's biased by the dots.
Other people might cherry pick some labour market data right now. Lisa's talked about a few things. Entry-level hiring, not great at all. Job switchers, not getting that boost to pay. You talked about the labour market and the tightness there. Sufficiently tight to generate stronger payrolls growth, stronger wage growth that keeps this Fed reluctant to cut interest rates?
We've got an hourly earnings number of 0.4%. That's, again, consistent with a 4% rise. A 4% rise is consistent with 3% inflation. Fed's target's 2. We're at 2.7, our estimate for the upcoming PCE deflator. They're 7/10 off the mark, 3/10 closer to my number, 7/10 away from their number. I'm sorry, I think they're not in a position to cut rates. And if they were to cut rates, I think it would be a mistake. And I think you'd discover exactly what happened last year when they cut rates, and that is the long end of the curve would sell off. So it would be a bear steepener.
Which, at a certain point, is the reason why people are also looking to the auctions. Sorry, I had to say that. I've been remiss. There are auctions today and tomorrow, 2-year, 5-year, and 7-year notes, but also the Treasury refunding announcement that comes on Wednesday, when maybe we get a sense of whether any of this will matter for the U.S. government's debt financing costs, because maybe they'll issue everything in T-bills and just retire all of their coupon, all of their Treasury bonds. I mean, how much are you looking at that to really understand exactly how this Treasury Department is going to manage this and whether it's going to have any market ramifications?
Well, I think there's lots of reasons to expect bill issue sizes will go up. Back when I began, which was ancient history in terms of the market, one of the things I had to do was estimate the Treasury's operating cash balance. So I had to figure out financing and how to figure out the net cash flows. And we assumed every single quarter, a third of all the net new money would be raised in bills. That's not happening now. So, yeah, there's more bill issuance coming relative to coupon issuance.
When you came in, you said that there's something else that you're looking for.
Well, stable coin is something that I'm going to be looking to see whether or not Treasury Secretary Bessent, if he's back from his overseas trip, and talks further about stable coin than he did at the May refunding announcement. And he made a statement at that point in time that I think is stuck in a lot of people's minds, and I've visited a lot of accounts. And some of these accounts are very, very interested in the whole stable coin concept. And where do we go with stable coin and how much of it will be financed through bills? And he talked about $2 trillion market cap. You look at stablecoin now, it's about $300 billion. So that's telling you there's a long way to go. And I question whether or not, if you wind up with it being done properly, if you wind up, for example, the Federal Reserve issuing its own stablecoin, could you then be in a situation where we might actually replace a lot of our electronic transfers of wires and replace the SWIFT system with something more simple and less costly for the end result user? And I know the banks don't want this because clearly it influences a business they make a lot of money on, but clearly the end user wants it. I can imagine a place like Walmart, Target, Boeing, these big people, these exporters, these importers, all sitting there saying, you know, this would be great. It reduces my costs. I really think we have to do this. Right now, we've got lots of stable coins going in different directions and trying to do different things. If we could find one way of unifying it and putting them all on one network, or creating it all in terms of one large ability to do it, for example, with a Treasury coin hosted on a Federal Reserve website, I think you could get a very fast adoption of the technology.
Do you think it leads to increased T-bill demand?
I do think it leads to increased T-bill demand because I do not believe it'll affect currency in circulation, which affects the rest of the Federal Reserve's portfolio. Currency in circulation as a percentage of the economy, as a percentage of financial transactions, is not going down. Yes, a lot of the currency in circulation is outside the country, but we still have the currency that's in circulation winds up outside the country. But we do have, as a result of that, the big Federal Reserve portfolio, and I don't think it changes. So yes, what happens in terms of stablecoin, I think will be a net new demand.
Interesting. Happy to catch up with you this morning.
Cheers. A
lot of the audience writing in as well. Steve Rashuda of Mizuho having a tremendous year so far, dead on so far this year on a lot of issues.
He's never got caught up in this sort of recessionary call.
The crazy stuff?
No.
Didn't sound so crazy back in April.
No, listen, he did sound crazy in April, sorry. But he was right. And this is something that a lot of people are looking to. The stablecoin issue, we got to get more into that. We got to get someone on to really go deep dive into this. Well, yeah, but let's keep going with this.
OK, we'll keep trying. Mike McKee writes in, thinks I was dropped out of a spacecraft. So, Michael, thanks for that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Samsung Electronics will produce AI semiconductors for Tesla. Sources telling us here at Bloomberg the deal worth $16.5 billion will run through the end of 2033. Musk confirming it on X, saying the $16.5 billion number is just the bare minimum and that actual output is likely to be higher. The win for Samsung comes as it moves to regain ground in chip manufacturing. Meanwhile, Mark Zuckerberg is escalating his AI hiring spree. The Meta CEO announcing on Threads the company hired ChatGPT co-creator Shenzhen Chao as chief scientist of its super intelligence labs. Chao will set the research agenda and scientific direction for the new lab, which focuses on foundational model and next-gen research. And Boeing is preparing for factory workers to strike at its St. Louis defense hub after they rejected a contract offer. The International Association of Machinists and Aerospace Workers said its members overwhelmingly voted against the new terms that would have boosted their wages by 20%. The union represents 3,200 Boeing defense workers. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for a big week ahead. Plus, we'll catch up with Troy Gajewski of FS Investments following 5 straight days of equity gains, and we're looking to make it day 6.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
We're looking at deals with 3 or 4 other countries. But for the most part, I can't get them to understand that it's the letter. We just sent that letter, and that letter is, very universal for most. They'll probably receive a letter of clarification or a confirmation type letter, which will go out sometime during this week, prior to August 1st.
The president's trade deadline coming up on Friday, August 1st. What a week coming up as we count you down to the opening bell. This is your week ahead, your trading diary. Later on today, US-China trade talks underway in Sweden. Look out for the outcome from that. We're all expecting a 60-day extension or a 90-day extension for these talks. Coming up tomorrow, earnings from Starbucks. Wednesday, a Fed rate decision and Fed Chair Jay Powell news conference, plus earnings from Meta and Microsoft. Thursday, another round of jobless claims and results from Apple and Amazon. Friday, payrolls Friday, just around the corner.
Yeah, at a time when a lot of people think that this is a solid labor market, but some people, particularly on the Federal Reserve, are starting to see cracks, and that might be the justification to cut rates as soon as July, or at least those among the dissenting members may believe so.
Steve Rashida pushing back.
Pretty hardcore, saying absolutely there's no reason to, and watch out for the long end to really rip in terms of yields going higher.
How many banks have we got now saying no rate cuts in 2025?
Well, there's Bank of America.
Morgan Stanley.
Morgan Stanley has come out. Rashido's come out. There have been a number of people who have come out and said, look, there's no reason. Ed Al-Husseini is saying the same thing. There aren't really signs of it if you look at the firming up of the data and the surprise index turning positive over the past couple of weeks.
Let's keep it on the market right here on Bloomberg. Troy Gayeski of Future Standard writing this. The biggest issue for equities now that we have round-tripped on valuations is materially less upside. But if anything goes wrong, materially more downside. Troy joins us now for more. Troy, welcome to the program. The capacity to absorb bad news in the year ahead, do you think that's diminished over the past few months?
Yeah, it's certainly diminished greatly since, the several weeks after the Liberation Day plunge, because a lot of the technical strength that came in, first came from large multi-strategy hedge funds releveraging, and then it came from systematic trend followers. And then last but partially least, per se, would be the risk parity managers that as volatility drops, they can lever up their balance sheet and take more length. So, at this point, it's really all on retail dollars to continue to flow in to drive multiples higher. The point was just that compared to 2, 4, 6 weeks ago, or even 2 years ago, you just have a lot less technical strength to drive even further multiple expansion. And we are materially more expensive today, not only in the S&P, but also in small and mid cap than we were in 21. And at the time, the Fed was obviously pumping in a tremendous amount of liquidity, and we had massive fiscal stimulus and an economic rebound.
At this point, though, Troy, a lot of people are saying that multiple expansion makes sense given the technological advancement that will increase profitability and efficiency at a number of big U.S. companies. Why is that not enough for you?
Oh, well, look, I've been a big proponent for the last several years, if not longer, that the combination of having the greatest 5 companies in the world listed in the U.S., higher profit margins, tremendous free cash flow margins, combined with a very important technical of reduced supply of equities, which is pretty consistent in terms of 40 to 150 basis points of equity supply comes out. And we still have 4.6% more money supply relative to nominal GDP than we did prior to the pandemic, should drive multiples slightly higher over time. So we're basically 23.6. I think by the end of next year, end of 27, we'll be roughly 25 in the S&P. But that being said, it's just, when you're looking at a relative basis, do you want to put additional money to work at these rich valuations? When you have other options like private credit or middle market private equity, where you're getting NASDAQ-like revenue growth with much cheaper valuations. So it's a time, just like in alternatives, in capital markets, to be a bit more differentiating in terms of what additional capital you're going to put to work at this particular juncture in market and economic history.
Troy, this is something a lot of people have said when they've come on. They've said, if you want to diversify, bonds aren't going to cut it in the same kind of way. The dollar clearly isn't going to cut it. Gold is already pretty highly valued, so people go into alternatives. What makes you think that the past couple of years aren't a sort of a sign of what's to come, given the fact that we've seen real outperformance of public markets, actually, to a number of private markets, private equity in particular, and it's gotten pretty crowded in that space, too?
Yeah, well, I think, again, there's nothing wrong with having a healthy allocation to U.S. large and mega cap, right? We have tremendous fundamentals. Valuations are stretched. The question from an asset allocation standpoint is, what do you complement that with? Again, do you chase U.S. small cap at 28 times forward earnings based on 20% forward earnings growth, which I don't know any analyst that thinks that's really going to transpire? Do you instead chase a currency trade that drove really short-term outperformance of European assets, for instance, or international? Or do you focus on assets where you do have a tremendous growth, NASDAQ-like revenue growth as NASDAQ revenues come down, at much more reasonable valuations, approximately 35 to 40% below where the Russell 2000 trades on an EV to EBITDA basis. So that's the fundamental question, right? Now, to your point, look, a lot of the drawdown vehicles have struggled because multiples have come in substantially, and it's been hard to exit. However, the evergreen vehicles, which have been leaning mainly into secondaries and co-invest, have performed very consistently, including 22, which was the last doozy of a bear market, and also hung in there rather well during Liberation Day. Because when you're starting at very low valuations, and you have great growth, you have tremendous convexity, meaning you have less downside if things go wrong and more upside if the economy continues to expand.
Hey, Troy, appreciate the update. Troy Gursky there of Future Standard. Just getting some live pictures now that I wanted to send you over to Scotland with, over in Turnberry, the President of the United States alongside the British Prime Minister, Sir Keir Starmer, opening up that conversation on Gaza.
Yeah, real concern there about famine in the region, and they're talking about that, as well as the trade agreement that they came out with Trump saying that their relationship is unparalleled. What we hear about from Starmer is saying people in Britain are revolted by what they're seeing over in Gaza. So clearly something very concerning for him and for a lot of people.
They're certainly not alone. As we track that, we'll bring you the headlines as we get them right here on Bloomberg TV. Just want to set you up for tomorrow. What a lineup. Peter Chi of Academy Securities, Mike Wilson of Morgan Stanley, leaning into his bullish case for the rest of the year over the next 12 months. Stephen Stanley of Santander is looking for zero on payrolls on Friday, and the new biggest bull on Wall Street, John Stolfus of Oppenheimer, looking for 7,100 on the S&P by year-end.
One of the big surprises has been the upside revisions for a lot of companies and the upside projections for what's to come. How much is that behind suddenly all of the revisions upward by a number of stock bulls across the street?
What a year this has been, hey? July 28th.
What a decade, come on.
In the space of what? 2 months?
Exactly.
Feels like 2 decades.
I mean, well, we've gone around the trip and around the world in about in about a couple of weeks. So there you go.
Phenomenal. Live from New York City this morning. Good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Building another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
In case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
A lot of them. Congo was just, and Rwanda was just done. But you probably know, I won't go into it very much because I don't know the final numbers yet. I don't know. Numerous people were killed, and I was dealing with two countries that we get along with very well, very different countries from certain standpoints. They've been fighting for 500 years, intermittently. And we solved that war. You probably saw it just came out over the wire, so we solved it through trade. I said, I don't want to trade with anybody that's killing each other. So we just got that one solved. And I'm going to call the two prime ministers who I got along with very, very well and speak to them right after this meeting and congratulate them. But it was an honor to be involved, and that was going to be a very nasty war. Those wars have been very, very nasty. So we've done a lot of good work. We've had great support from the Prime Minister anytime we needed help, anytime we needed any form of support. You've been there. We appreciate it very much. Absolutely. And we're going to continue onward. We do have to take care of the humanitarian needs at what they used to call the Gaza Strip. You don't hear that line too much anymore. You don't hear the Gaza Strip. But it is the Gaza Strip. And it's amazing that it's not being handled a little bit differently. We're going to set up food centers, and we're going to do it in conjunction with some very good people, and we're going to supply funds. And we just took in trillions of dollars. We've got a lot of money, and we're going to spend a little money on some food. And other nations are joining us. I know your nation's joining us, and we have all of the European nations joining us, and others also have called, and they want to be helpful. So we're going to set up food centers and where the people can walk in and no boundaries. We're not going to have fences, and they can't. They see the food from 30 you would say yards away, and they see the food. It's all there, but nobody's at it because they have fences set up that nobody can even get it. It's crazy what's going on over there. So we're going to work very closely together with your country, a great country. We also discussed inside that we are, there's a whole new thing happening with regard to energy from nuclear. Yeah. And the Prime Minister's looking at that very strongly. And I know you have Rolls-Royce nuclear plants. That sounds pretty good, right? I love that. What a great brand that is. But you're also doing the Rolls-Royce or the nuclear plants, the smaller plants. We're doing smaller and bigger, but the small is interesting. They do a small plant, very easy, very safe, and as they need more, they hook up another plant, and they have a series of plants instead of, doing the $20 billion plant. That gets tough for a lot of people to do. So we're just studying that. It sounds like you're very far progressed, but that's a great thing you're doing on nuclear. We opened up nuclear about 2 months ago, and it's now safe and very inexpensive.
No, we see civil nuclear as a big part of the future as we go to sustainable, independent energy. And I think that between the two of us, we can work very much more closely on this. And we've agreed that that's our ambition, that's our aspiration. And this is going to be a big part of the future when it comes to energy. And you can see in the last few years, energy has been weaponized. Prices have dictated both families and businesses across the United Kingdom, and therefore taking control of energy is a huge prize. So the more we can work together on this, the better. And small modular reactors are a very big part of the future here, and we've got great companies like Rolls-Royce involved in that. So I'm very much looking forward to working together with you, Mr. President.
We'll do that. We'll do that. We're going up to your oil capital in a little while. We're going up to Aberdeen. That's called the oil capital of Europe. And that's a great asset that you have up there someday. If they ever change their thinking on that, you have a great and valuable asset. There's a lot of valuable resources underground there. But that's a decision for you to make. But it's a very amazing place, and it is considered the oil capital of Europe. So it's another option that you have. So we are doing really well as a country, and I think that the Prime Minister has been so supportive of us, and so strong and so respected. And I respect him much more today than I did before because I just met his wife and family. He's got a perfect wife and family, and that's never easy to achieve, right? But
I take no credit for that.
But he's become a friend, and together we got a deal done that has not been able to be done. It was a deal that's very good for both parties.
A really good deal for both of our countries, and very, very well received here in the United Kingdom.
So thank you very much for having us.
Thank you.
That's President Trump speaking in a bilateral meeting, as you can see, with the Prime Minister of the United Kingdom, Keir Starmer. They are in Turnberry in Scotland right now. Bloomberg's Lizzie Burden is in Scotland as well, her native country. Great to get you on this story, Lizzie. What do we know about this deal? There have been some conflicting details, with President Trump saying that pharmaceuticals won't be included with the EU deal. I'm referring to, obviously, not a UK deal. And but Ursula von der Leyen saying pharmaceuticals are indeed included in the 15% tariff.
Well, indeed, there was a disparity between the two readouts from their meeting over the weekend, Matt. You had President Trump thinking that the EU would be charging 0% tariffs on US goods, and Ursula von der Leyen, the European Commission president, saying that that's only for certain goods, mind you, like certain agricultural products, certain chemicals. And if you're going to have 0% tariffs from us, we expect the same back. We can agree a list and that list can grow, but look, these are the details that need to be ironed out down the line. The reason that you saw relief, at least for certain European equities in the session, is because you've got this 15% US tariff agreed on most EU goods, and that this is all inclusive so that you don't have extra tariffs when it comes to, for example, chips or drugs, or for other areas as well. But these details have, as you say, to be ironed out. We've also got Keir Starmer talking to Trump there. What an unlikely partnership, right? They have nothing in common, nearly, when it comes to the personal side or the ideological side. And yet Starmer was the first in line to get that trade deal, which Donald Trump is heralding. Now the conversation turns to Gaza and the humanitarian crisis that is happening there. So much pressure on Starmer to press Trump to revive those press talks. So much pressure to get him to recognise Palestine as a state in itself. We'll have to see where those talks lead to. Apparently he's got a plan that he's presenting to the president. We don't have the details at the moment, but Gaza very much, as much in focus alongside trade.
All right, Lizzie, appreciate the on-the-ground update. That is Bloomberg's Lizzie Burden reporting from Turnberry, Scotland. And there may be more deals to come as China and U.S. officials meet today in Sweden. Bloomberg's Oliver Crook is in Stockholm, where those meetings are taking place. So certainly a win for the U.S. administration when it comes, of course, to that deal with the EU. How does that set us up for these negotiations with Chinese officials?
Yeah, well, we heard from Jamison Greer, the U.S. trade representative, saying that basically they come into these discussions with China off of a big win on their trade negotiations with Japan, with the European Union, and as a consequence, they don't feel great pressure to strike a deal with China at the moment. We just had Scott Bessent and Jamison Greer walk in right behind me there. We also had the Vice Premier of China just walk in about 30 or 40 minutes ago. Their meetings are now underway within the Prime Minister of Sweden's office, which he's sort of very kindly lent out for these trade negotiations. What we will have here likely over the next 48 hours are discussions about the panoply of issues that they disagree on trade and probably beyond. But before any of those issues get resolved in a permanent way, what they need to do is extend the runway for the trade truce that is currently in place between the United States and between China. U.S. currently has 30% tariffs on China. That is down from the 125% tariffs that they did have when there was the escalating tensions between the two sides. They brought that down. That is supposed to expire on August the 12th. So number one priority for the negotiators in those rooms is to extend that runway and then to start talking about the broader issues, the overcapacity that China sends out to the rest of the world, to the United States, other issues such as the continued purchase of Russian and Iranian crude oil, the issue of TikTok. Trump has said that there is a buyer in the United States. That still needs sign-offs from the Chinese side. But as usual with the Trump administration, the way into the conversation is through the trade plank, but there are a panoply of different issues that they want to discuss with the Chinese.
All right, Oliver, thanks very much. Bloomberg's Oliver Crook there reporting live from Stockholm. He'll continue to cover that story for us. Now, trade deals aren't the only story investors are going to need to digest this week. A fire hose of economic data is set to be released. Here with a look ahead is Bloomberg's international economics and policy correspondent, Michael McKee. Mike, so a lot of economic news.
A lot of economic news. The question is it going to be all sound and fury signifying nothing, or is it going to change the perception of where markets will go for the rest of the year? We're going to have to wait and see on Friday. But Tuesday, we start off trade, then jolts in confidence on this program. You're going to want to be watching. Wednesday, GDP and ADP. ADP will really suffer in comparison. GDP is going to be important. Going to be hard to know exactly what it means because of the trade distortions we saw earlier this year. So pay attention to analysts like us. Thursday, income and spending, PCE, and the employment cost index, which is the Fed's favorite measure of employment costs. We'll see if there's some inflation building there. Jobless claims, of course, everybody watching. And then Friday is Jobs Day. We'll recap that on open interest. And then we get the ISM and Michigan numbers on open interest. I'm just promoting you guys, if you don't mind that at all.
We appreciate it.
And what really matters, of course, is on Wednesday, the Fed meeting. Fed's going to leave rates unchanged. The question is there any signal about September and any kind of encouragement for markets to think they'll go in September? And what does Jay say? Not just about September, but about Donald Trump, about the buildings that they're criticizing him for. A lot of questions for the Fed chair. So Wednesday is going to be the big day, but there's going to be something for everybody to follow every other day this week.
All right, yeah, a lot to look forward to. Maybe Jerome Powell in another hard hat. We can only pray. That is Bloomberg's Mike McKee on the big economic week. But investors are also bracing for the busiest week for corporate results of the season. Bloomberg cross-asset reporter Isabel Lee tracking their performance so far. And Isabel, what does the scorecard look like as we head into such a busy calendar?
It's a pivotal week, Katie, that's really likely to set the tone for the rest of the year. So we have a busy economic calendar, but also here in the equity market, we will see a deluge of earnings. Nearly $24 trillion of market cap is slated to report. That's more than double what we saw last week. So today, Monday, we'll see Waste Management. Tuesday, we have Procter & Gamble, United Health, Boeing, UPS, Starbucks, and Visa. Then things ramp up on midweek. Come Wednesday and Thursday, 4 of the 6 largest S&P 500 companies will report. I'm talking about Microsoft, Amazon, Apple, Meta. The market cap of those 4 amount to $11 trillion, basically the same for the entirety of last week. So Meta sales growth should be the slowest in 2 years. Microsoft faces questions over the ramifications of a cyber attack. Apple, its Greater China revenue is seen rising for the first time in 2 years. And Amazon, we have the core business there remaining healthy in the face of tariffs. So as a whole, bottom line beats seem to be coming in strong so far. We have Bloomberg intelligence showing that companies are generally beating forecasts with profits up 4.5% year over year. And other noteworthy companies are Reddit, Coinbase, Chevron, and Ford. So really, you take your pick, Katie.
All right, Bloomberg's Isabel Lee, appreciate the update. 4 of 7 magnificent 7 names report this week. So certainly going to be busy. Let's take a look at the setup as we head into the first official trading day of this week. You can see pretty quiet, Matt Miller. The S&P 500 only about 0.1% higher. Of course, we're kind of in wait-and-see mode across all of those indexes right now.
Yeah. However, it does look like we'll hit all new records again, at least momentarily, and we closed at record highs on Friday as well. Coming up, Tesla is teaming up with Samsung in a multi-billion-dollar, multi-year deal to make chips in the great state of Texas. We'll take a look under the hood. Next, this is Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Tesla shares are leading the Magnificent Seven higher this morning after announcing a chips deal. Samsung will produce AI semis for the EV maker as part of a new multi-year pact. The deal is worth $16.5 billion, although Tesla CEO Elon Musk just posted on X that the figure is, quote, just the bare minimum. For more on this Tesla deal and Magnificent Seven earnings to come this week, we're joined now by Bloomberg Tech co-host Ed Ludlow. So, Ed, Musk also wrote on X that the strategic importance of this is hard to overstate. We won't try to overstate it, but just give us the context here of what this means for Tesla at this moment.
Well, it onshores and diversifies the supply of the AI chips that make up and power the full self-driving computer in each car. The specifics are really important because the deal with Samsung is for AI 6, which is 2 generations of chip into the future, essentially. Samsung already manufactures for Tesla the AI 4 chip, which is in the hardware 4 generation of vehicles. And in the interim, between getting from that existing Samsung chip to the next one, which will be done in the United States, Tesla has in parallel an arrangement with TSMC, where TSMC will make AI 5 first in Taiwan and then later bringing it to Arizona. But it's just so case in point on how long-term and expensive and difficult it is to manage your technology development pipeline along with the contract manufacturer that's going to make it. And you mentioned Tesla shares were up more than 1% in the pre-market, but overnight Samsung shares really reacted to this because much like Intel, Samsung's contract manufacturing business has really fallen behind. So it's a big vote of confidence by a big customer in Tesla that they are doing this with Samsung, noting that they're also doing something in parallel with TSMC.
It's funny, it seems to me fairly short term. They want to start producing chips in Texas already, Samsung does, starting next year, Ed. And this deal only goes out to 2033, right? So are they going to be able to ramp up quickly enough? And is this going to save Tesla money? Is it going to be cheaper to produce chips at an all-new fab in America than it would be with TSMC in Taiwan?
So 2033 seems quite far away to me, knowing that, again, AI 6 is 2 generations from where we currently are AI 4, but Tesla moves quickly on the R&D cycle. What Elon Musk said about this is the reason they went with Samsung as opposed to others is that they would allow Tesla to be involved in the engineering and ramp up of output because Tesla believes itself to have prowess in that domain. And what Musk said on X was that the fab in Texas is near his house, so he can go and personally stroll the line, which is not really how semiconductor manufacturing works. It's like a very sterile, clean environment. I don't know. But that's the element that Tesla can have control even though Samsung's basically a contract manufacturer for them.
Well, a bit of good news for Tesla this morning. Ed, we have to talk about what's to come this week.
Yeah.
Apple, Amazon, Microsoft, Meta, all taking the stage. We're going to be paying attention to all of those names and the numbers that they bring. But in your view, what do investors really need to pay attention to as they sort through the different numbers coming out of these giant companies?
Well, the thing that's analogous to all of them is, of course, tariffs. You know, in Meta's case, which is an advertising story, ad spend slowing down in specific geographies depends on the macro environment, and tariffs have an impact on that. Otherwise, you know, Meta's spending on talent, AI, etc. Apple is impacted in that story. But tariffs are interesting because so far with Tesla or General Motors, many other companies, you can quite easily quantify the impact they've had. And what Apple in particular told us in the last earnings call was, for this current period, tariffs are going to have a $900 million cost. But for a company that's going to book more than $90 billion of revenue in this period, 62 billion of which is hardware specifically, 900 million doesn't seem like a lot. Mark Gurman has led all our reporting on all of these executive changes at Apple, but historically the story has been about Tim Cook and the former CFO being able to manage the cost, supply chain and bottom line. You now have a new CFO in Kevin Perek, and a very different and difficult set of circumstances that Apple's going to have to manage, and that will be interesting. Again, Amazon, it's domestic retail business. There is a tariff component, but for all of these companies, the AI story is the core of it, where you want to see growth, in Amazon's case, through cloud. So there's a lot there. The question I have for you guys, I send one back to you. Didn't see that coming on Monday. First official day of the week is, what's more important this week, right? Earnings or the Fed and economic data? And I think earnings are going to run it really close because we'll learn a lot about the state of play.
Yeah, I would agree with you that earnings are more important because I doubt we're going to get much out of the Fed and economic data that shows us what happens from tariffs compared to what we'll get in the second half of the year.
I like that Ed asked a question, but then answered it himself. I thought that was a good
Well,
move.
what's your answer? Everybody
Well,
chip
if you
in.
both are saying earnings, I feel like I have to take the other side of that trade. Maybe we'll get a surprise out of the jobs report. Maybe we'll get a surprise from Jerome Powell, but probably earnings.
All right, Ed, thanks very much. Ed Ludlow, of course, is the host of Bloomberg Tech, and you can catch that show in 1 hour and 39 minutes. Coming up on this program, we're going to ask Citi's Scott Cronert if he's getting bullish on stocks after all-time highs were put in, like every day last week. Also, we have more people on the street raising targets. Maybe he'll join in. This is Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Well, Oppenheimer is the latest firm to raise its S&P 500 target. Strategists led by John Stoltzfus raised their year-end target to 7,100 from 5,950 as trade progress removes uncertainty. That is a street high. Joining us now is Citi U.S. equity strategist Scott Kroner joining us now. I want to ask if you're going to raise your target now, since we had John on the show last week, and it sounded like he was getting there. But let's talk about trade uncertainty. Resolving a little bit this morning, you have a deal between the U.S. and the EU. But, Scott, I see the S&P 500 only up about 0.1%. That seems pretty tepid relative to the news.
Katie, well, I think what's happening here is that as we move further and further away from those Liberation Day lows, and you're seeing more signs of these trade deals happening, they essentially begin moving to the background in terms of an overhang on markets. But as you get more comfortable that the deals are coming, I think you can expect that there's probably a less of a positive bias to the actual news announcements. I think what's left ahead is how do these actually translate in earnings growth expectations, which comes back to your earlier question, and how do you think about price targets?
All right, Scott, we're going to hold you over. I'll ask you if you're going to raise your targets soon. Scott Kroner from Citi stays with us through the open. The bell up next, and as Katie says, we're only up about 0.1, not even of a percent on S&P futures. This is Bloomberg.
How are we going to get the debt down and the deficit down if we have these big tax cuts?
Well, David, let me just say, I think the deficit is probably the most important issue today in terms of the long-term impact on the economy. And just to put this in perspective, in the first term, we had debt to GDP ratio of about 100%. And with the tax cuts and economic growth before COVID, we were growing the economy faster than we were growing the debt. So that ratio would have come down. And I think we were trying to get it down to 90 to 95. The big focus on the first term was military spending. We unfortunately had to increase non-military spending to get it through the House and Senate. But what really impacted us was COVID. And I think, as you know, firsthand, we had to spend a lot of money in COVID or we would have had a worldwide depression, not recession. I think the problem was, the first $2 trillion was well spent. The next $2 trillion we never should have spent. And then the Biden administration kept on spending. So, we have debt to GDP of close to 125% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP, and that's got to be a major focus.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
We are moments away from the start of trading on this Monday, July 28th. Looking at slight gains on the S&P 500 futures contract, almost 0.1%, 0.2 on the NASDAQ, 0.5% on the small caps. A lot of people saying this is a win for President Trump, a win for the U.S., and maybe a loss for the EU. That's the trade deal I'm talking about. Southside Bank shares ringing the bell to mark their 65th anniversary. The shares are up less than 40% over the last 5 years. They're actually down year to date, so something they may need to turn around. Meanwhile, over at the NASDAQ, Stockyards Bank and Trust ringing the bell. How old are they? 25 years, but if you bought those shares 5 years ago, you're up 120%, assuming you reinvested the dividends, so you're doing quite a bit better. Katie, what are the stocks you're watching today?
Well, I'm keeping an eye on the intraday movement of what's going on in energy and defense stocks on the move as the EU plans big purchases of American products from those industries. That is part of that trade pact. And you take a look at the reaction, and you can see it is green, not huge moves here. And that definitely seems to be the theme so far today, but we know it is a consequential week. Matt Miller.
All right, Samsung, as we've been talking about with our own Ed Ludlow, is going to produce semiconductors in Texas for Tesla. It's a multi-year deal worth at least $16.5 billion. The CEO of Tesla says they'll probably buy multiples of that. And Morgan Stanley strategists say their S&P 500 bull case is playing out. Mike Wilson's team reiterated that a recovery in earnings revisions is underway, and that he and his team are leaning more towards their 12-month bull case. That's 7,200. I believe it's to the end of the first quarter, so it's not a year-end target, but still, it's pretty hot. We're back with Citi's U.S. equity strategist, Scott Cronert. And Scott, you guys have a 6,300 target. We're there and then some. Do you think we continue to climb into the end of the year?
Well, I think that's certainly possible. We use 6,300 for our base case, and that's sort of something along the lines of what we'd consider fair value for the S&P. But when sentiment shifts to the positive as it has, then anything can happen. Now, we also banned our base case with bear and bull cases, and our bull case for several months now has been 7,000. So that 7 number as a starting point for thinking about index objectives is certainly out there. But what it's going to take, Matt, is a lot more conviction in durability of this economic cycle, and that's going to entail Fed getting a little bit easier as the year unfolds, more confidence in earnings growth coming out of the concerns we dealt with in the first half of the year, and importantly, perpetuation of this AI spending and infrastructure playbook theme that still is going to be, I think, mission critical to how this market acts short term and longer term.
Absolutely, and that's how a bull case potentially becomes the base case. Well, let's narrow our focus to just what's going on this week. This is also a conversation we were having with our own Ed Ludlow. When you think about all that is sitting ahead of us in the next 5 trading days, we have big earnings, we have big economic data and a Fed decision, and we also have trade negotiations underway, importantly with China. What do you think will be the deciding factor of this week's mood music?
For me, honestly, it's this what inning are we in the AI build-out discussion? And that comes back to fundamentals, right? So essentially, for my perch, what can disrupt the action in the market? It's that 40%-ish of the market that's mega cap growth that's tied to this theme. So we need to see ongoing confidence that the CapEx playbook is in place, that these companies are beginning to see evidence they can monetize some of these new product offerings. And what that leaves you with is confidence that we're still early innings in a playbook that may extend several years. That's what you need to keep this going. Then the Fed comes in. Eventually, we get to lower rates as we go into the post-summer time frame. What that does is then it begins to allow the market to broaden even more so to those areas that are more traditionally let's say, sensitive to interest rates. That's going to be consumer, which includes home builders. It's going to be other areas, telecom, utilities, and so forth. So a combination of leadership persisting and then some broadening into other sectors as time passes and more confidence in future economic conditions and growth trajectories unfold. That's how you get to a 7 handle on the S&P.
What do you need to see in terms of earnings? I'm just looking, we're trading at 23 times forward earnings right now. So I guess your 2026 expectation would have to be like 310 or something. Are you there?
Well, that's where it goes, Matt. So our base case is 295 for next year. Our bull case, remember how we get to 7,000, is a more heady valuation on 305 in earnings. So what you need to see, which we're beginning to see right now actually, is consensus numbers lift, not so much as a function of revisions, but because what's happening in terms of company guidance is that they're no longer as conservative as they've been on the second half of the year and then looking ahead to next year. So what that does is enable consensus to begin to lift. It takes some of that valuation pressure off.
All right, Scott, and I hear what you're saying, and we're juggling, of course, all these different factors. You have a bull case out there. Regardless of whether we're talking about the bear case, the base case, the bull case, is there any area of the market, is there any specific industry or specific name that you can point to and say, this probably does well regardless? We have high conviction here.
Well, I think where we're going with this, our big bull discussion point, if you will, Katie, is that we're looking at the free cash flow generation for the S&P 500 really beginning to accelerate, and that gives you lots of financial flexibility. It enables cap spending. It also enables share repurchases. That Mag 7 component, X a couple of them, are really critical to that. So what I would say here, again, the leadership in our view has to continue to be in these mega cap growers. And, we continue to be overweight software, semis as part of our playbook on this. Eventually, you want to see the hardware companies benefit from some of the broadening. So you see where this takes us. It takes us, you rely on that big leadership to continue to drive the bus. But then what happens is that you begin to fill out behind that. And that's, I think, still an important second half story here. So I would say color us ongoing constructive on growth in all of its manifestations.
Scott, what are the companies or what are the sectors that really get hit from these tariffs? Because we continue to see what look like wins, right? President Trump getting a 15% tariff on European Union goods and everybody breathing a sigh of relief. There was a time when that would have terrified this market. Right. But company after company after company in the U.S. says, all right, I guess we're going to have to pay for that. So we're taking $1 billion off our full year earnings, or we're taking $2 billion off our full year earnings, or we're taking $3 billion. This isn't something that Europe is paying for. This is something that American companies and consumers are going to foot the bill for. So which sectors see margins shrivel?
Well, you set it up perfectly for me. We've been underweight consumer discretion and staples for the better part of this year. And quite honestly, when we look at the tariff setup, we've argued for some time, yes, there's a little bit of an inflation read-through, but this is really a gross margin issue and headwind. And we think those consumer sectors are smack dab in the line of sight for where tariffs are coming through. Beyond the consumer sectors, you begin to feel it or should see it to some degree on the industrial side. But then there are other areas of the marketplace that are somewhat unaffected. Financials would be an example of that. I'm leaving out healthcare. Healthcare is a controversial discussion point right now from a sector perspective. A number of headwinds, including tariffs, that continue to play out there. But where I'd focus in terms of the negative is how these consumer discretionary names are in position to respond to this. And then the last point on this, really important, is what's the market pricing in already? The market's been figuring this out for several months now, that this company here, that company there is going to be affected to a certain degree by tariffs. So what we're dealing with in the broader market is not so much where the next tariff wave comes in and hits, but what's already baked into expectations. It's sort of a really interesting dynamic that unfolds here. So less bad than feared ends up becoming pretty good on some of these tariff discussions.
Yeah, just to that point on healthcare. Healthcare shares, the worst performing sector year to date. Just can't catch a break there. Scott, always great to speak with you. Thank you for spending some time on Monday with us. That is Citi U.S. equity strategist Scott Cronert. Let's take a look at this rally right now. If you can call it that, the color is green, but really tepid gains so far this morning on the S&P 500. As Matt pointed out, that's good enough for a record, but a pretty uninspired record. Taking a look at the different components here, you can see you do have a lot of tech names on the rise today. NVIDIA, Meta, Advanced Micro Devices, Amazon, trading places here at the top. We know it is a consequential week for tech earnings, so continue to keep a look on those names. Look at the downside, though. This is where it gets a little bit more interesting. You have Johnson & Johnson, one of those healthcare names that just can't seem to win this year. Also Cisco, Accenture, the list goes on. Can't get a clean read there in terms of the sector. So let's take a look at that breakdown specifically. You do have almost an even split, maybe a little bit more red than green. Up at the top, you do have energy leading gains this morning. We know that comes back to that trade deal that the U.S. secured with the EU. Technology also up there as well. Then you take a look at the bottom. You have consumer staples, utilities, and materials is your worst performing sector. Just about 10 minutes in to the session, Matt Miller, down about 0.9%.
All right, we'll continue to track these markets and watch for another closing high on this Monday. Coming up this week, earnings from some of the biggest companies on the planet could change that. We'll talk Mag 7 results with Gil Luria, D.A. Davidson, head of technology research. Next, this is Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Welcome back to Open Interest. It's time now for our top calls, some of the analyst action in focus this morning. And first up, JP Morgan is upgrading Nike to overweight from neutral, calling this an inflection point for revenue growth, which is expected to jump in 2026 and 2027. You take a look at the reaction in shares, up about 2% at the moment, at one point hitting their highest level intraday since March. Up next, Evercore downgrading Cisco to inline, pointing to the recent 30% rally, which has priced in potential upside, some of that coming out this morning as a result. And finally, we have Wolf Research upgrading Texas Instruments to outperform, setting an end to its years-long investment phase, which will create stronger cash flow and margins by 2027. Shares currently up about 2.5%, Matt.
All right. Those are some of the analyst moves. Let's turn back to the earnings that drive a lot of those things. This week, we have a ton of them, including 4 of the Mag 7 out this week. Microsoft and Meta on Wednesday, Apple and Amazon on Thursday. For more, we bring in Gil Luria, D.A. Davidson, head of technology research. And Gil, I was perusing those companies and wondering myself, which of them would be most affected by tariffs? Obviously, Apple has a big supply chain, all of it outside of the U.S., and Amazon as well sells goods that are, for the most part, made in China. How do you calculate the hit of these tariffs to those companies?
Yeah, that's been very hard to do, but I think you have the right order, which is first and foremost Apple, which has had to very quickly shift supply chains from China to India. Even that hasn't gone smoothly. They've already told us that there's going to be a big hit to margins from that, so we're going to track that. For Amazon, there's some impact. Obviously, a lot of their sellers sell from China, but Amazon is so broad and flexible, and consumers can move their demand around. And so the impact there is going to be probably more muted. Then longer term, if tariffs are disruptive, that'll impact the ad market and maybe Meta and Google. And the only company that's safe here is Microsoft.
The only company that's safe is Microsoft. Well, we'll get to Microsoft, but I do want to pick on Apple a little bit more, because the narrative that's formed around Apple is not just that they're an also-ran in AI, that they are firmly behind the pack when it comes to artificial intelligence. But you take a look at shares down 14% on a total return basis year to date. Gil, does that create a situation where the bar is so low for Apple that maybe it's easier to surpass expectations at this point?
It is, but this is probably not the quarter that happens. What Apple has shown us is that even without really having compelling AI products integrated into their handsets, there's still an upgrade cycle. It's a fairly muted one. What you know, though, with Apple is that people aren't going to switch away, which means they have time to get it right. As long as they get these AI features right at some point over the next couple of years, there will be a bigger upgrade cycle, and that's what investors are hanging on to. So expectations are low, probably for a reason. There's probably not a lot of upside, and it's more about where can they go in the next couple of years, both in terms of more compelling AI products within the handset, as well as maybe a new form factor for next year. Many iPhone users look at Android users with some envy when they see the folding phones. Maybe we get that next year. So Apple is more of a play into what happens over the next couple of years. Their consumers are sticky. They're not going anywhere.
Well, Gil, I was talking to a woman over the weekend who runs a company here in New York, sources all of her goods from China, and has said that after negotiating a 10% discount with her suppliers and raising prices marginally, she's doing okay. What does that look like for Apple? Cost of goods sold, if it's 60%, it's really 15% would be a 10% tariff. They're going to raise prices a bit. Consumers end up paying a few percent more. What does the back of the napkin math look like in your office?
Yeah, so it's still in the hundreds of millions of impact, mostly on margins. They'll sell as many phones. They'll probably still sell them at similar ASPs. So they guided to hundreds of millions of dollars of impact on margins, exactly because how you described it, which is they have three levers. One is to push margins down on their vendors. One is to increase prices a little bit, and one is to accept margins that are a little lower. And again, the net of that is going to be the top line will probably have fairly limited impact, and the margins will compress a little bit, but again, not enough to really change the trajectory, probably within the guided range at this point at least, unless we see negotiations fall apart and tariffs pick up from here, which seems less likely at this point.
Well, to state the obvious, Gil, the common thread through these earnings, other than tariffs and trade, of course, is artificial intelligence. And we know that Meta in particular has been on a really huge acqui-hire spree, if you want to call it that, basically spending so much money to attract AI talent. And I'm curious about how that will be talked about on the earnings call. What kind of questions that company executives will receive and how you're thinking about it as an analyst. In one sense, of course, they're getting the best and brightest inside their doors, but you think about compensation costs just through the roof.
Yeah, I think it's possible that this quarter, Meta may have spent as much on talent as it did on chips. Between the investments to hire Alexander Wang and the couple of folks out of SSRI, they may have spent close to $20 billion this quarter, which will be probably right around where they spend on CapEx.
Wow.
Mr. Zuckerberg believes that he has to win in the AI model race, that Meta cannot come in second, and he will do whatever it takes. That is a very aggressive stance that he shares maybe with Mr. Musk and Mr. Altman. They are AI maximalists. They think that we are on the precipice of such accomplishments from the AI models that he will not risk being second. In terms of investors, as long as the ad business is growing sufficiently, which in their case is going to be mid to high teens, they're going to allow him to do that.
But
they're
Gil,
going to be okay with this spend.
Can anyone else match that? I mean, it bears repeating what you just said. $20 billion is what Mark Zuckerberg's going to spend on talent for AI, right? Google, I think this year they're spending $85 billion, but that's going to be on compute. So is anybody else in the industry going to be able to match that, or are the best and brightest going to end up working for Facebook?
So OpenAI is compensating its staff very well, mostly based on the increasing in the share price. Anthropic won't give up. Google certainly won't give up. And then you still see an aggressive accumulation of talent at Microsoft as well. So we are going to have a multi-headed race here to achieve that top of the line model. Mr. Musk, in his many enterprises, investing also in a similar way. So there's a race here. It's an important race, but right now, Mr. Zuckerberg's the most aggressive.
Yeah, to put it mildly there, $20 billion on talent. That year of efficiency for Meta certainly feels like a long time ago. Gil, great to speak with you. That is Gil Loria. He is D.A. Davidson, head of technology research. Now, coming up next hour, we'll dive into memes and frothiness in markets with Bob Sloan of S3 Partners. This is Open Interest.
you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersace in Vienna, and this is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing after we got the U.S.-EU trade deal. You can see S&P 500 and NASDAQ both rising. The tech stocks doing a heck of a lot better than the broader index right now at a 0.4% gain, 23,367. S&P's barely at 6,400. In terms of the stocks that are rising, NVIDIA helping out there with an 0.8 boost. Apple is unchanged right now. You can see Tesla rising after the deal with Samsung. Chevron and Cheniere putting up some gains after the EU says it's going to buy a lot, I think $600 billion worth of energy assets. Katie, what are you looking at in terms of the week ahead?
Well, continuing to watch for any trade headlines because President Trump continues his visit to Scotland with Treasury Secretary Scott Bessent. He's meeting his Chinese counterparts in Stockholm for trade talks. Wednesday, we get that Fed decision expected to hold rates steady, but the press conference will be fun. After the bell on Wednesday, this is when the fireworks really start. We get earnings from Microsoft and Meta, followed by results from Apple and Amazon on Thursday. And we end the week with the July jobs report on Friday. Plus, President Trump's tariffs are due to take effect. The date is August 1st.
Coming up the next hour, Miriam Bartels joins us from Sanctuary Wealth, as well as Bob Sloan from S3 Partners.